All right, let's talk about it. For what feels like forever, one little 3-digit number has had this incredible, almost scary amount of power over our financial lives. But what if I told you its reign might finally be coming to an end? We're not just talking about a minor tweak here. We're talking about a full-blown revolution that is completely rewriting the rules of credit. Let's dive in.
So let's just get right to the million-dollar question, the one that's on everybody's mind. Is the credit score, the number we've all been trained to obsess over, is it actually dead? Can we all just breathe a sigh of relief and stop worrying about it?
Well, not so fast. The truth is, it's not really dying. It's evolving. And I think the financial analysts at Stratify put it perfectly. This isn't an ending. It's the start of something completely new, and honestly, something way, way more interesting.
Okay, so to really get where we're headed, we have to first understand why the old system is broken. Let's dig into why a single static number just doesn't tell the whole story about you and your money anymore.
I want you to just let this number sink in for a second. 28 million. That's the number of adults in the United States who are considered credit invisible. What does that even mean? It means that to the entire traditional credit system, they might as well not even exist. No file, no score, no chance. And this slide right here, it just nails the core of this whole shift. The old score is just a snapshot, like a dusty old photo from your past. It only looks backward at your payment history. But this new model, it's like a movie, a real-time movie of your financial life. It's looking at your present, your cash flow, your income, your spending habits to get a much clearer, much more accurate picture of you today. So if we're going from a snapshot to a movie, you're probably wondering, what's the technology that's even making that possible? Well, the answer is cash flow data. And believe me, it is the powerful engine driving this entire revolution. The whole thing works because of a concept called open banking. Now, don't let the name intimidate you. All it really means is that there's a secure way for you to give other companies permission to see your financial data straight from your bank. And here's the most important part. You are in control. Your permission is the key that unlocks this whole new, fairer system. And with that key, lenders can now do something called cash flow underwriting. So instead of just looking at whether you paid a bill late 5 years ago, they can actually analyze your real-time income and spending. You see the difference? It completely changes the question from, so how have you been, to how are you doing right now? And the best part is this is all happening seamlessly right on the phone in your pocket. With just a few taps, with your consent, you can link your bank account and a lender gets an immediate, up-to-the-minute look at your financial health. We're talking about getting loan decisions in seconds, not sitting around waiting for days or weeks. It's a total game changer. And listen, this isn't some fringe idea cooked up in Silicon Valley. This has some serious backing from the people at the top. The director of the Consumer Financial Protection Bureau, Rohit Chopra, has gone on record saying that this kind of real-time data is an incredibly useful tool for figuring out a person's actual ability to pay back a loan. That's a huge stamp of approval.
Now, I know what you're probably thinking. This all sounds great for some new startup, but what about the 800-pound gorilla in the room, FICO? Well, you might be surprised to hear they are not just sitting around watching this happen. FICO is moving, and they're adapting to this new world of data. So first, let's talk about the FICO Score 10T. If we go back to our analogy, the classic score was that one snapshot in time. Well, the 10T is more like a 24-month movie. It uses what's called trended data to see the direction you're moving. Are you paying down your debts? Are your balances growing? It actually rewards your positive progress over time, not just where you were on one specific day. But this is where the future really clicks into place. FICO has announced a massive partnership with a company called Plaid. Now, if you've ever linked your bank account to an app like Venmo or Acorns, you've used Plaid. This is the moment the old world officially shakes hands with the new, and it's a very big deal. So, what's born from this huge partnership? It's called the Enhanced Ultra FICO Score. And the formula is actually really simple, but it's so powerful. You take the traditional FICO score that lenders have trusted for decades, and you add a brand new layer on top, your real-time cash flow data, which is made possible through Plaid. It's literally the best of both worlds coming together.
So what's the bottom line here? For you, what does this actually do? Well, it means that for the first time, your entire financial picture can be part of the decision. All those good habits you have, your consistent savings, your steady income, all of that can finally get you the credit you deserve, telling a much, much richer story than a single number ever could.
So all of this is leading us to a huge shift in how we even think about being creditworthy. Let's get into what this evolution really means for you personally, and let's talk about this new idea of a trust score. So think of it this way. The trust score is the new paradigm. It's not just about how you've handled debt in the past. It's a living, breathing, holistic measure of your overall financial reliability. It combines your history with your present-day habits, how you earn, how you spend, how you save, to create a much more complete and, frankly, a much fairer assessment of who you are. And the real-world impact of this? It's absolutely huge. This finally opens the door for those 28 million credit invisible people we talked about. It helps gig economy workers whose income isn't always a steady paycheck. It forces assessments to be based on what you can actually afford today. And you know what happens when lenders have a clearer picture? Less risk for them means better rates and more personalized offers for us. Everyone wins. You know, I saw this analogy on Reddit and it just hits the nail on the head. It said a traditional credit score is like trust in a relationship. If you mess up just once, that trust plummets, and it can stay down in the dumps for a very, very long time. That one late payment from years ago can still be holding you back. This new model is so much more about rewarding your positive actions right now. Okay, so this is all happening. It's not science fiction. The big question is, what can you do, starting today, to prepare for it? How can you start building a financial story that's going to shine in this new world? All right, here's your action plan. It's pretty simple. First, focus on that positive cash flow. Lenders want to see that you're consistently bringing in more than you spend. Second, try to maintain a healthy savings buffer. It's visible proof that you're financially stable. And of course, the old rules don't just disappear. History still matters, so keep paying those bills on time. And finally, please understand your data rights. With open banking, you are in the driver's seat. You give permission and you can take it away. If you only remember one single thing from our entire conversation today, please let it be this. The fundamental shift, the big idea, is that we're moving from rewarding your history to rewarding your habits. Your consistent, responsible, day-to-day financial behavior is about to become your most powerful asset. And that really just leaves us with one final and I think really empowering question. For decades, it felt like our financial story was written for us by these mysterious agencies based on old data. But in this new era of data that you control, of these holistic scores, for the first time ever, the person who truly controls your financial story is you.
Wow, that was something, right? But don't go anywhere, there's more coming, and it's gonna make you think in a whole new way. Quick reminder, if you like learning cool stuff without the fluff, subscribe now. You won't regret it.
Have you ever looked at the ultra-wealthy and wondered how they do it? How they seem to buy super yachts, fund new companies, and live these incredible lives, all while their net worth just keeps climbing and their tax bills seem, well, tiny? It's not always some shady, hidden loophole. A lot of the time, it's a financial strategy that's so powerful, it honestly looks like a magic trick. It's a playbook for turning wealth that's on paper into cold, hard cash in your hand without ever having to sell a single thing. So let's pull back the curtain.
So that really is the billion-dollar question, isn't it? How do you actually use the money that's all tied up in your stocks, in your real estate, in your business, without hitting that sell button and immediately writing a massive check to the IRS? Well, the answer lies in this simple three-word phrase that's been kind of the secret handshake of the super rich for decades.
And here it is, just laid out perfectly by USC law professor Edward McCaffrey. He's actually the guy who coined the term for this whole strategy way back in the 90s. And listen to his words. He calls it a game that allows the rich to avoid federal taxes. It sounds almost too good, or maybe too simple to be true. But this entire game is built on the very foundation of the US tax code. Okay, so let's crack open this playbook. It's called Buy, Borrow, Die. It sounds a little morbid, I know, but once you understand how each of these three steps works, you are going to see exactly how wealth can be accessed, used, and then passed on, all while legally sidestepping the tax man. It all boils down to these three pillars. First, you buy assets that you expect to grow in value. Stocks, real estate, maybe even art. Second, you borrow against that growing pile of assets to get cash for your lifestyle. And finally, the die part, which, believe it or not, is the most powerful piece of this entire puzzle. Let's break down the tax rules that make each step tick. So the buy phase works because of one critical concept: unrealized gains. Let's say you buy a stock for $1, and over the years it skyrockets to $100. That's a $99 profit. But you don't owe a penny of tax on that profit as long as you don't sell the stock. It's just an unrealized gain. It's all on paper. The tax is deferred, potentially forever. That's key number one.
Okay, now for the borrow phase. And this is where it gets really clever. When you go to a bank and they lend you money, the IRS doesn't consider that income. Why? Well, because you have to pay it back, right? You have an offsetting debt. So you can take out $1 million loan against your stock portfolio, and that $1 million lands in your bank account completely tax-free. You've just turned your on-paper wealth into real, spendable cash without selling a single share.
And that brings us to the grand finale, the die phase. Seriously, this is where the real magic of this whole strategy happens. It's a provision in the tax code called the stepped-up basis. And what it says is that when you pass away and leave an asset to your kids, your heirs, the price you originally paid for it is basically forgotten, wiped clean. The asset's new cost basis becomes whatever its market value was on the day you died. Just look at the difference here. It's absolutely wild. On the left, if you bought an asset for $1 million and sell it for $10 million, you're paying a big chunk of capital gains tax on that $9 million profit. But look at the right. If you hold that same asset until death, your heirs inherit it with a new cost basis of $10 million. They can sell it the very next day for that $10 million, pay off any loans you took out, and guess what their taxable profit is? Zero. A big fat nothing. That entire $9 million gain, poof, it just vanishes, at least for tax purposes.
So if borrowing is the engine that makes this strategy go during your lifetime, what's the specific vehicle that the wealthy are using? I mean, it's not like they're just going down to the local bank for a personal loan. Nope, they use a specialized tool designed for exactly this. It's called a securities-backed line of credit, or an SBLOC for short. The easiest way to think about it is like a home equity line of credit, a HELOC. But instead of using your house as collateral, you're using your brokerage account, all your stocks, your bonds, your ETFs. It's this flexible, revolving line of credit you can tap into whenever you need some cash. So what makes these things special? Well, we've already covered the first two big ones. You get cash and you avoid capital gains tax. But that third point is absolutely crucial. An SBLOC is what's called a non-purpose loan. That's just a fancy way of saying you cannot use the money to go buy more stocks. That's a huge distinction. And number four, that interest rate is usually variable, which is a risk we are definitely going to circle back to. Now, a lot of people get SBLOCs confused with margin loans, but as you can see here, they are very different animals. A margin loan is for leverage, right? Its purpose is to buy more securities. An SBLOC is for literally everything else: funding your lifestyle, buying a vacation home, starting a new business. It's also structured as a separate thing, which usually gives it a bit more of a buffer against market swings compared to a much higher risk margin loan. Okay, so I know what you're probably thinking. This is great for billionaires and the characters on TV shows, but what about the rest of us? For decades, this was a tool exclusively for the ultra-rich, kind of hidden away in the private banking world. But is that still the case? Is this strategy starting to become more mainstream? And the answer to that is a resounding yes. The whole landscape for these products is absolutely changing. What was once the sole domain of billionaires is now becoming accessible to a much, much broader group of investors. And it's all thanks to fintech and retail brokerages deciding to get into the game. And this one number right here tells the whole story. At a brokerage like Interactive Brokers, for example, you can now potentially get access to a securities-backed loan with a portfolio of just $110,000. I mean, that is a world away from the multi-million-dollar accounts that private banks used to demand as a bare minimum.
And even at the private banks, those minimums are coming way down. It's not uncommon now to see these offered to clients with maybe around $200,000 in taxable assets. So this is no longer just a billionaire's game. It's becoming a tool for the mass affluent. But, and this is a really, really big but, there's a price to pay for this power.
Right, and this is where we need to get very serious, because this strategy isn't really magic, and it is absolutely not risk-free. Using leverage, which is all this is, borrowing against your assets, it comes with a price. And if things go sideways, that price can be absolutely devastating. This quote here just sums up the danger perfectly. The moment you borrow, your portfolio is no longer just yours, the lender has a claim on it now. And if the market turns against you and the value of your collateral starts to drop, that bank is going to act to protect itself, not you.
In that demand for corrective action,
That's what's known as a margin call. It's the single biggest risk in this entire strategy. You've probably heard the term, and trust me, it's as scary as it sounds. It's a formal demand from your lender that says, you need to put up more cash or more stocks right now, or we are going to start selling your assets for you to cover this loan.
And this chart shows just how fast it can happen. You start out in a pretty safe spot. You've got a $500,000 portfolio securing a $200,000 loan. Plenty of cushion. But then a nasty market crash hits. Your portfolio's value plummets to $300,000. All of a sudden, that loan is a huge percentage of your portfolio's value. You've crossed the threshold, and that's when you get the dreaded call.
And here is the absolutely brutal consequence. The lender doesn't ask you if it's a good time to sell. They don't wait for the market to recover. They just sell your stocks right there at the bottom of the market to get their money back. And in doing so, they lock in your losses permanently. You can wipe out years, even decades of hard-earned gains in an instant. And the very tax bill you were trying to avoid? Well, now it's due on those 4 sales.
And it's not just the nightmare of a margin call. There are other serious risks to think about. Market volatility is a given. But remember, we said these loans often have variable interest rates. If rates spike, your payments could balloon overnight. If your portfolio is too concentrated in just 1 or 2 stocks, your risk is amplified like crazy. And a lot of these loans are short-term, meaning you're under pressure to refinance them down the road, whatever the market conditions are. So when you boil it all down, this is the real trade-off you're making. This isn't really a strategy to avoid a cost. It's a strategy to trade one type of cost for another. On one side of the scale, you've got taxes. It's a predictable, calculable cost that you ultimately control by deciding when to sell. On the other side, you've got interest payments and leverage, a variable, unpredictable risk tied to global market forces that are completely out of your control. You're swapping certainty for risk.
Which leaves us with the final big question. Is buy, borrow, die a form of brilliant financial alchemy that lets you turn your assets into a tax-free lifestyle? Or is it just a high-stakes gamble, trading the certainty of taxes for the catastrophic risk of a market crash blowing up your life savings? The answer, as with most things in finance, really depends on just how much risk you're willing to take.
Wow, that was something, right? But don't go anywhere, there's more coming, and it's going to make you think in a whole new way. Quick reminder, if you like learning cool stuff without the fluff, subscribe now. You won't regret it.
Okay, let's talk about something you own that's incredibly valuable, probably more valuable than you think. And here's the crazy part. You've been giving it away for free for your entire life. I'm talking about your data, your digital footprint. It's literally been called the new oil. And for decades, huge companies have been building empires on it without cutting you in on the deal. Well, guess what? That's all about to change. Today, we're going to break down how you can finally take back control and maybe even start getting paid for it. Just let that quote sink in for a second. You are being harvested. It's a strong word, but it's true. Every single thing you do online, every tap, every search, it's all making somebody else incredibly rich. But look at that last line. This era of, data serfdom, it has an expiration date, and it's coming up fast. A massive shift is on the horizon, built on one simple, powerful idea. Your data belongs to you. And this isn't some sci-fi movie plot. It's happening right now.
So, how in the world did we get here? For the last 20 years or so, we've all been participating in this unwritten agreement. And if we're being honest with ourselves, it's a really, really bad deal. So first, let's pull back the curtain on how this whole thing has worked up until now.
For years, we've lived under what's called the Softian bargain. It's the whole reason your favorite social media apps are free, right? You trade your data, your habits, your interests, where you go, and in exchange, you get to use their service. The problem? They get to turn around and make billions from that data, and you get nothing. No control, no visibility, no paycheck. But this new sovereign model completely flips the script. Just imagine your data is a personal asset, like your car or your house. You own it. You get paid for the insights it provides, and you get to do it all while your actual identity stays completely private. You hold all the cards. It's a massive shift in power. Back to you.
Now, I can hear you thinking, okay, that sounds cool, but what is my data actually worth? Well, if you look at just the online advertising industry alone, the average user's data is worth around $263 a year. And I know, that doesn't sound like retirement money, but that's just one piece of the puzzle. Multiply that by billions of users and factor in all the other industries that use data, and you start to see that we've been giving away an absolute goldmine without even realizing it.
So here's the problem boiled down.
Your personal info is the raw material for a multi-trillion-dollar industry, and you, the supplier, get zero compensation. And those terms of service agreements we all scroll past and click accept on, they're designed to be impossible to understand. I mean, did you know PayPal's terms of service is actually longer than Shakespeare's Hamlet? It's nuts. And it's created this completely lopsided deal that just isn't fair to any of us. So, why now? What's the big catalyst that's finally forcing this broken system to change? Well, the answer is the single biggest thing happening in technology today: artificial intelligence. The new generation of AI models are incredibly, unbelievably hungry for data, and that hunger is about to change everything.
And check out this timeline because it really shows you how urgent this is getting. Just back in 2022, researchers were already predicting that we would eventually run out of public data to train AI. Now, just a few years later, investors are pouring hundreds of millions of dollars into new data solutions. But the date you really want to circle on your calendar is 2026. That's the year many experts predict the well of high-quality public data, stuff from the open internet, is going to run completely dry.
And this, my friends, leads us to the billion-dollar, or maybe even trillion-dollar question that everyone in Silicon Valley is asking right now. If every book, every article, every public website has already been scraped and fed to the machine, where does AI get its next meal? Where does it find the fresh, authentic human data it needs to keep learning and improving? The answer is you. It's us.
And this is the moment. This is where the whole game changes. It's where you stop being the product and you start being the owner. The key to all of this is a new kind of tool, built specifically for this new economy. It's called the Sovereign Data Vault. And really, the easiest way to think about it is like a digital safe deposit box for your most valuable asset.
And it's pretty much exactly what it sounds like. A super secure, encrypted vault that puts you, and only you, in complete and total control of your data. You get to decide who can access it, why they get access, and exactly what they can do with it. And the best part? You can do all of this without ever giving up your privacy.
So what's the magic making this all possible? It's Web 3. If you think about the old internet, Web 2, it's kind of like a kingdom ruled by a handful of giant companies. Well, Web 3 is more like a democracy. It uses decentralized technology to take the power away from those big corporations and put it back into the hands of individuals. Back to us. It's all about building a fairer, more transparent data economy where everyone gets to participate.
So how does this actually work? It really boils down to 3 simple steps. First, you consolidate your data. You gather up your digital footprint from all over the web. Second, you encrypt it and lock it down in your own private vault, where you have the only key. And third, this is the cool part, you can then license access to it. You can use things called smart contracts, which are basically like digital vending machines. A company can pay to ask a very specific, anonymous question and get an answer, but they never ever get to see or touch your raw personal data.
Okay, now for the part I know you've been waiting for. Once you're in control of your data, how do you actually earn from it? This is where we start talking about the data dividend, and what's really exciting is that there isn't just one way to do it.
Now, this next point is absolutely crucial. I want to be crystal clear here. This is not about selling your personal information. You're never selling your name, your email, your address, no way. What you're doing is renting or licensing anonymous insights derived from that data. Think about it this way. A company doesn't need to know that you specifically bought a certain brand of coffee. They just want to know that someone in your zip code did. They want the pattern, not the person. Your privacy stays completely intact.
And a whole new marketplace of strategies is starting to pop up around this idea. For example, you could join a data co-op. It's basically like a union for data owners where you pool your data with others to get more bargaining power. Or you could earn usage-based royalties, getting a tiny micropayment every single time your data helps train an AI model. You could even have companies bid in a reverse auction for the right to ask your encrypted data a single question. Or you could just trade specific info, like your safe driving data from your car, directly for a lower insurance bill. The possibilities are actually pretty amazing. And hey, don't think this is just some fantasy on a whiteboard. This is real. There are actual companies building this new infrastructure as we speak. You've got platforms like Oro, which provides high-quality permissioned data for AI. There's iEthelium, building a peer-to-peer data marketplace. And even companies like Data Vault AI, which focuses on monetizing things like a person's name and likeness. The future is literally being built right now. So, let's bring it all together. What we're witnessing here is the very beginning of a brand new data economy.
It's a fundamental shift, and it's one where you, the individual, are finally put in the driver's seat as the true owner of your own digital life.
Now, let's be real for a minute. This is brand new territory. As organizations like Data Catalyst have pointed out, there are still a lot of hurdles to clear. We've got to figure out how to make this stuff work seamlessly for everybody. So no, this isn't going to happen overnight. But the most important part, that fundamental shift in ownership from them to you, that's already happening. The train has left the station.
So, if you only remember 4 things from our talk today, make it these. Number 1, your data is an incredibly valuable asset, and it's getting more valuable every day thanks to AI. Number 2, new Web3 technology is finally giving you the tools to actually own and control it. Number 3, you can earn money by renting out anonymous insights, all while protecting your identity. And number 4, this all adds up to a potential new stream of passive income, what we're calling the data dividend.
And I'll leave you with this final thought to chew on. Whether you realize it or not, a digital twin of you already exists out there. It's been built from every click you've ever made, every search, every purchase, and right now, it's being bought and sold every single day without your permission. As this new economy finally takes shape, there's really only one question left to answer. Who gets the paycheck? Them or you?
Thank you for spending time with us here at the Violet Vault. Don't forget to like, subscribe, and drop your thoughts in the comments below. I'd love to hear from you. Until next time, stay focused and keep growing.